Hello everyone, my name is Hitesh and I welcome you all to YouTube channel of Trade Brains. If you're new to our channel, please don't forget to subscribe and comment and like on the videos. Now today's video solves one of the biggest questions which every option trader has. Anyone who is starting new, anyone who has traded for some time in the market always gets confused with this concept, and the concept which I'm talking about is implied volatility or IV in short form. We'll try to understand what is this concept, how is it used, how does it work in the money option, at the money option and out of money option, and we'll also understand that how does it affect the call options and the put options. But before understanding about that, let us understand what exactly is implied volatility. So according to Investopedia, the term implied volatility refers to a metric that captures the market's view of the likelihood of changes in a given security price. Investors can use implied volatility to project future moves and supply and demand, and often employ it to price options contract. Now, don't get confused with so many jargons and so many terms. In simple terms, basically implied volatility tells you what is the likelihood or what is the expected volatility in the securities price over a period of generally next 1 month. Now, so that is the basic premise of the concept of implied volatility. Now, in general, the implied volatility is used a lot when one is trading options. So let us focus on this option chain and learn more about it. So this is the option chain which I've taken from the website of nseindia.com, and I'm looking at the index futures. So this is, the market is currently trading at around 17,895. It is trading near the all-time high. And we'll start with focusing at the money contracts. If you look at my screen, on the left hand side you have the call option, and on the right hand side you have the put option, and you have IV on both sides, IV on the call side and IV on the put side. If you look at the 17,900 call option, the IV is about 10.49, and if you look at the 17,900 put option, the IV is 13.19. In general, the IV for the put option is always more than the IV for the call option. It is a general tendency, the fall in the market is always much more steeper than the rise in the market, and the negative events impact the market much more than any positive event in the market, and which is where for the put option the IV is always on the higher side, because you expect more volatility when the market is coming down than it's going up. There is no hard and fast rule that the market going up will be less volatile than the market coming down, but if you look at over the history, the falls are more aggressive by nature than the markets going up, and which is why the implied volatility for put option is always higher than the implied volatility for the call option. Now if you go a little up or higher in this option chain, if you look at say put option of say 16,000 or 15,500, if you see on the screen, the implied volatility is about 42.31%. All the number mentioned for the implied volatility are always in terms of percentages. It's 42.31%. Why does it happen so? The premium for those kind of options which are very far away from the market, I'm talking about the out of money options, they are going to be somewhere around 1 rupee, 1.5 rupee, 2 rupee. So a move from 1 rupee to 1.5 in premium is a 50% move, which is where the volatility is on the higher side, and which is where the implied volatility is always much more as compared to at the money option or in the money option. Remember this, be it call option or put option, the implied volatility is much higher for out of money option in both the cases. Now let us understand how does one comprehend the implied volatility. It is very simple. If the implied volatility is very high, we are expecting higher range movements in the market. And if the implied volatility is on the lower side, we are expecting smaller range in the market. So that is how you comprehend the concept of implied volatility. Now let us try and understand as to what kind of implied volatility does an option buyer want as against what kind of implied volatility an option seller want. If you are a buyer of an option, you would obviously want the market to be moving faster, which means you would want higher implied volatility. And if you are a writer or seller of an option, you would want a smaller range movement in the market, which is why you kind of like lower implied volatility if you are an option writer. So that is a simple analysis of what kind of volatility does a particular kind of option trader likes. Now the next important question which you could have is that how does one know whether the current implied volatility is at high or low? Now there are two ways of understanding it. First is through implied volatility rank, and the other is through implied volatility percentage. Now what you do in this case is you basically look out for the range over say last 1 year. Say the range for last 1 year has been between say 10 and 40 for implied volatility, which means there's a 30-point gap between that. And if you're saying okay, the current volatility is say 20, which means it is from the low to the current point, there's a gap of 10 points. So you take the 10 as numerator and you divide that by the overall range difference, which comes out to be 30, and you get an implied volatility rank in that case. But it is not always necessary that it gives you a correct picture, because sometimes the market must have gone to the higher range only once and it has always stayed below the market current implied volatility range. In that case, sometimes implied volatility rank doesn't give you the accurate number, and which is where the concept of implied volatility percentile comes into picture. It tells you what is the current level or what is the percentile of the current volatility in terms of over the last 1 year. I'll give you a simple example for that. Over the last 1 year, the range has been in between 10 and 40, which means the range is about 30 points. And supposedly the current volatility is 20. And we have to see in how many observation or over the last 1 year of say 365 days, in how many days the market has been below the 20 percentile range and the market is between 20 and 40. And if the number of days between say 20 and 40 is say 60, and the number of days in between 20 and 10 is 305, then how do you find the current percentile, or how do you find the percentile of the current volatility? You take the number of observations which are above 20 and you divide that by 365, you get a certain value, and that is the percentile of that volatility. I hope this is clear. It is very important for us to understand that. If you understand the percentile factor, you would know that what is the status of current level of volatility. Is the volatility high in terms of the range over the last 1 year, or is it the normal range over the last 1 year? Now there are websites through which you can easily find the percentile and you don't have to calculate it. I'll show you how do you go about searching them. So what you gotta do is you just visit the website of obstra.definededge.com. You just log in through a simple Google login ID, and you can see for different level of share price or trading in the derivative segment, you can find the implied volatility percentile. I have chosen say example of Adani Ports. You can see what is the implied volatile percentile, which is 22.98 as I marked on the screen. So you would know that the volatility of the current share price of Adani Ports is on the lower side. So this is a simple way of understanding that how is the current volatility when compared to overall range for the market. And to sum it up, implied volatility basically tells you what is the expected range over the next 1 year in the underlying asset. Higher the volatility, which means higher range, and lower the volatility, which means lower range. A higher volatility stock price always have more premium to be paid for all the strike prices, and lower volatility stocks always have a lower premium charged against it. I hope this small and simple video gave you a decent understanding of the concept of implied volatility. If you have any more questions regarding this topic, please put everything in the comment section. I'll be more than glad to answer it. I thank you for your patient hearing. I'll again send future videos of financial education. Thank you so much.